Stock transfers under GST. What is stock transfer? The movement of goods between different units or locations of the same organisation. Under GST, taxability of stock transfer depends on whether the goods movement is between distinct persons and whether the locations have separate GST registrations. The concept of distinct persons is pivotal in GST. Section 25(4) of the CGST Act states, "A person who has obtained or is required to obtain more than one registration, whether in one state or more than one state, shall, in respect of each such registration, be treated as a distinct person." In simple terms, different GST registrations under the same PAN are treated as separate taxable entities. Supply of goods or services or both between related persons or between distinct persons shall be treated as supply, even if made without consideration. Let's move further to understand scenarios of stock transfer. Intra-State Transfers within the same GSTIN. If the goods move within the same state and under the same GST registration, there is no supply for GST purposes. Key compliance points. No tax invoice is required. Issue a delivery challan instead. Generate an e-way bill if the consignment value exceeds 50,000 rupees, Rule 138. Record the transfer in stock registers for audit trail purposes. Now, what if supplies within same state but different GSTIN? Even if both GSTIN belongs to same legal entity, it will be treated as taxable supply. Another scenario: interstate or inter-GSTIN transfers, taxable movement. Compliance requirements. Issue a tax invoice with applicable taxes. Generate an e-way bill based on the invoice value. Report the transaction in GSTR1 and GSTR3B. Let us understand valuation of stock transfers rules. Rule 28 of CGST rules deals with valuation of goods. As per rules, GST must be paid on the value of supply, as per Section 15 of the CGST Act, read with Rule 28 of the CGST rules. There are three different approaches to determine value. 1. Open market value, OMV. Price at which goods are sold to unrelated parties in similar circumstances. 2. Value of like kind and quality. If OMV is unavailable, use the value of similar goods sold. 3. Rule 30, Rule 31 methods. Cost-based or residual valuation methods. Special provisions. If the goods are meant for further supply as such, the supplier may value them at 90% of the recipient's sale price to unrelated customers. If the recipient is eligible for full ITC, the invoice declared value is deemed to be the OMV. Second proviso to Rule 28. Thank you.